Nigam Arora, the founder of the Arora Report. And always a pleasure. Good to have you back on the program here. Let's talk about why you feel there could be a stronger than usual year-end chase here in these final couple months.
Well, Alex, very few money managers run concentrated portfolios. Most of them run very diversified portfolios. And sometimes, it's not even their discretion, right? It's written in their charter or whatever fund they're running that you shall not hold more than 5% of one position, and so on and so on. And here we got Nvidia, 8% of S&P 500. So many money managers, and I look at our members who are money managers, are underweight in Nvidia. And so they're underperforming. So what are they going to do? I mean, as much as they can, they're going to try to buy more Nvidia going into the year. And with 8% weight, that drives everything up, which lifts the sentiment up. And then Mag 7 overall is now 35% of S&P 500. And the same concept, managers who prudently diversified are underweight in Mag 7, and they're underperforming. So going into the year, they want to catch up with the indexes at least, if not beat them. So they're going to buy Nvidia, they're going to buy Mag 7 stocks, anything that dips, like Meta has now dipped after earnings, I expect it to be bought.
This seems like something that might be shocking to many at home, that it's even possible some of these names could be underweight in portfolios. These seem like, career-breaking decisions. But as you said, some of the charters or the prospectus of these different fund managers just simply don't allow them to carry positions that big. So not to push back, but how could they grow those positions? If anything, aren't they going to be selling them to get back to their 5% cap or whatever that cap would be?
Well, from what I see is at least what we see with a lot of our members is, they have Nvidia like 3%, 4%. That's what I see. So they might be able to go another 1% or 2% up. And then they're going to buy some related companies, right? Why do you think something like Micron, MU, memory maker is running up so high? Because the managers, if they start running into their caps, they're looking at stocks that kind of move that are very highly correlated with Mag 7. So that pushes the whole market higher, and that's why the tech does well.
Yeah, that's always interesting, question, right? Though. Because it's like you're diversified, but you're diversified with high correlated items. How diversified are you? But that's a conversation for a different day. Let's talk January effect. I know it's November, but we know the market's forward looking, and there's a reason that there's this whole concept. For those at home who maybe haven't heard of it, do you want to walk us through what you mean by that and why It might be time to start thinking about it already?
Sure. So, Alex, it used to be a long time ago. I've been doing this for a long time, 30 years ago. You went out and bought what I call January effect stocks in last week of December, and you made 20-30% in a month. But, as people have learned, more people have more information. So this starts happening early. And now I expect November is the time to buy these stocks for January effect. So let's talk about what January effect is. So two things happen at the year end. One is investors have a lot of gains, like we have this year, and investors are looking to, especially if they sell something, they don't want to pay taxes, so they're looking at the stocks where they have losses, they want to sell them. So the stocks that haven't done well get artificially sold because of tax loss selling, somewhere in November, early December in this period. And there are down spikes, and you will see some days there will be big down spikes on stocks that haven't done well. And the second thing is, as we start getting close to the year end, so money managers, after a year, they're going to send out to their client, their letter. This is what we were holding at the end of the year, and no money manager wants to show their clients, we were, holding the worst performing stocks. Nobody wants to do that. So they start selling. So these stocks come under tremendous pressure at this time of the year. And of course, when the calendar turns, two things happen. One is that selling pressure lifts. And the second thing is what I've observed, how it starts, is that Wall Street professionals get very big bonuses. And what I've seen is Wall Street professionals tend to look for bargains They don't tend to go for the high flyer stocks. So they are looking for bargains and they're saying, oh, well, let's look at these stocks. They have been really, really sold. So let's buy them. And once these stocks starts moving, then they start forming formations, technical formations like a double bottom and so on. And the crowd that follows the technical analysis say, oh, these things have bottomed. They start jumping up and start buying these and so on. So what happens is you kind of from the trough to peak, trough sometimes in November, peak sometimes in mid-January to early April, you start seeing as much as 30%. In some years, we have seen 50% move up in many, many of these stocks. And on an annualized basis, these are just superb returns. Now, some points of caution, you don't want to buy one or two of these stocks. You want to buy a basket. We just published a list of 26 stocks. So you want a basket. You want to be well diversified because some of them will not work. And then some of them will have, 50% return, 100% return. So you average out to about something like 30%. So that's how it kind of works out. We've been doing this for 30 years, every year. About 80% of the time it works great. 10% of the time, well, we don't lose money, we don't make money. About 10% of the time we end up losing money. So those are pretty good odds.
You can kind of see how these two things work together too. You were talking about the chase. Now you're talking about the January effect and how that's driven by tax loss harvesting and the selling of window dressing, I guess would be the term people like to say. And so let's talk about that basket strategy. You got about a minute, 2 minutes here. High level, kind of the way you approach this at the Arora report to kind of reduce that risk. You walk through some of those probabilities of success over time, but how maybe making those baskets improve those odds in your experience.
Yeah, so we talked about diversification, right? So on one hand, we're going to see a chase on these big Mag 7 AI stocks, right? And then the other technology stocks that people are buying are really correlated to them. But now with this January effect, what you're doing is the strategy is totally uncorrelated. You're buying the stocks that have not done well, right? So they're not correlated to Nvidia or Microsoft or Google or anything like that. So that gives you a very, very nice diversification in your portfolio. And but again, these are not long-term holds, right? You're trying to hold them for about 3 months typically and take your money and run.
Yeah, no doubt. Excited to see where things shape up. It's been such a fascinating, not only last year, but last 2-3 years as this AI build-out continues to roar on. But we got to leave it there. Always a pleasure. Thanks again to Nigam Arora of the Arora Report.